Inflation is a decrease in the purchasing power of money, reflected in a general increase in the prices of goods and services in an economy. Or in simple terms, it's the general increase in the prices of goods and services in an economy due to an imbalance of supply and demand.
That's inflation for you.
There are several factors affecting inflation, some of which are: 1. Cost-push inflation. Cost-push inflation occurs when prices increase due to increases in production costs, such as raw materials and wages. The demand for goods is unchanged while the supply of goods declines due to the higher costs of production. As a result, the added costs of production are passed on to consumers in the form of higher prices for the finished goods. 2. Fiscal policy, like tax reduction. While taxes are known to increase with time, sometimes governments reduce taxes to gain popularity among people. The people are happy because they have more money in their hands. However, if the rate of production does not increase with a corresponding rate, then the excess cash in hand leads to inflation. 3. Built-in inflation, which is sometimes referred to as a wage price spiral, occurs when workers demand higher wages to keep up with rising living costs. This causes businesses to raise their prices to offset their rising wage costs, leading to a self-reinforcing loop of wage and price increases. 4. High demand for goods and services. When supply is less than the demand in the market, this leads to an increase in prices as consumers are willing to pay more for the product or service, thus inflation increases. 5. Demand pull inflation. Demand pull inflation refers to situations where there are not enough products or services being produced to keep up with demand, causing their prices to increase. While inflation has proven to be a silent wealth killer for aspiring citizens, some have worked their way around and found ways in which to benefit from inflation, and that's through investing. When it comes to investing, risk and reward go hand in hand. The phrase, "no pain, no gain," comes close to summing up the relationship between risk and reward.
No pain, no gain.
What pain?
Don't let anyone tell you otherwise. All investments involve some degree of risk. It's important that you understand that you could lose some or all of the money you invest. The reward for taking on risk is the potential for a greater investment return. If you have a financial goal with a long time horizon, you may make more money by carefully investing in higher risk assets, such as stocks or bonds, than if limit yourself to less risky assets. Investing is always a tricky business, but when you are investing during inflation, it can be even trickier. When the prices of goods and services are going up, your money is worth less and less each day. This is why investing during this time requires careful research and analysis of the market and adjusting to the current economic situation. So with that being said, here are some of the smart places you can put your money during a surge in inflation. Invest in stocks. Essentially, you want to focus on companies that have pricing power. These are companies that can raise their prices during hard times and still won't lose their consumers. Companies like Apple and Coke are great examples as they have loyal customers and won't lose customers even if they increase their prices. Companies that have a low capital requirement are also a great choice. These are companies that don't require a lot of money to produce their goods or services, as they can easily take money out of their business and it won't affect how their business runs. Great examples of these companies are tech companies like Facebook and Twitter. Yes, you could argue that they still require money to run and improve their business, but it won't cost as much as those companies that require materials to produce their goods or machines to run their productions. With time, machines wears out and these companies are forced to buy new ones to keep running their operations. As the great investor Warren Buffett once said,
"Look for companies that can increase prices and handle a lot more business without having to spend a lot."
You can also focus on investing in a diversified portfolio of stocks as they are an excellent way to fend off inflation. Get started by choosing an S&P 500 index fund or S&P 500 ETF, which tracks the index's return and keeps costs ultra low. Because they contain hundreds of stocks, they provide simple, low-cost diversification, which reduces risk and portfolio management headaches. From July 2012 to July 2022, the S&P 500, a key benchmark for U.S. stocks, generated an average annualized return of nearly 11% with dividends reinvested. After accounting for inflation, you're still looking at about 8.3% average annual returns.
More money.
Bonds. Bonds are a type of investment that pays you interest for lending them money for a certain period of time. The interest rates on bonds vary depending on the bond issuer and type of bond, but they typically range from 1% to 5%. Bonds also tend to have lower risk than stocks because they don't depend on how well the company performs. Bonds stay at the same price until they mature, so if you need your money back before then, you can sell them for their current market value. There are different types of bonds out there, but a more popular one during inflation is Treasury inflation-protected securities, or as it's commonly known, TIPS. TIPS are U.S. government bonds, first issued in 1997, that automatically go up in value when inflation rises. TIPS is an intelligent way to keep a portion of your money safe and entirely beyond the reach of the long invisible claws of inflation. Because the full faith and credit of the United States stand behind them, all Treasury bonds are safe from the risk of default or non-payment of interest. TIPS also guarantees that the value of your investment won't be eroded by inflation. You insure yourself against financial loss and the loss of purchasing power.
Power? What power?
Real estate. Real estate traditionally does well during periods of higher inflation, as the value of a property can increase. Real estate is an excellent option for investors who want to take advantage of inflation in the long term. The prices of real estate tend to increase over time due to inflation, which makes it an attractive investment option for those who have enough money in the bank account. As a landlord, you can charge more for rent, which in turn increases your income, so it is on pace with the rising inflation. But as promising as that may sound, real estate investing can be a risky investment because there are many factors involved, such as the location, property type, and whether you're renting or buying your property outright. You need to do your research before investing in real estate because it's not a one-size-fits-all solution for everyone. Gold. Gold symbolizes wealth, prosperity, and power, but most importantly for investors, gold is the hedge against inflation. Investing in gold is an investment that has been around for centuries. It has been used as a store of wealth because it doesn't corrode or erode with time. Gold has shown a robust ability to outpace inflation. Looking back over the years, gold prices have kept up with inflation and its purchasing power has increased accordingly, while the US dollar has lost value and purchasing power. For example, in 1930, 0.01 ounce of gold could buy 2.3 loaves of bread, and $1 could buy 11 loaves of bread. Fast forward in time. In 2022, 0.01 ounce of gold could buy 8.6 loaves of bread, but $1 has lost most of its value that it can only buy half a loaf of bread. When gold does well, its returns are often so spectacular, sometimes exceeding 100% in a year. Thank you for watching this video, and I hope it has taught you something and helped you understand more about inflation and investing. If you liked it, please consider subscribing, liking, and sharing it with your friends and family who you think might benefit from it. Thank you once again, and see you next time. Peace be with you.